This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion.
Something a little different today. I'm going to reach into an associate of mine who's not yet been on my show. I think I'll get him one day. A guy named John Hussman, who runs Hussman Funds. John is a value guy. He is not a trend-following guy, not a quant guy in the way that I think of quant. But John is a very smart guy, and John has a very unique way, a very straightforward way of describing current market environments compared to past market environments. Now, some people will immediately think that I'm telling them to do something. I'm not. John might be. That's his business. But what I want to do is to take some of John's words and let you think about them. Let you think about what John is describing, where we are right now in 2021. John starts off his February 2021 newsletter with a quote. Quote, "The nutshell is this. The old line economy stocks just don't work because they have earnings and eventually rising interest rates impact earnings. New economy stocks have no earnings, so investors don't see a need to exit." End quote. That was a Wall Street analyst on CNBC early March 2000, and as John notes, said with a perfectly straight face. You market historians out there might know that March of 2000 was the high of the dot-com bubble. And from that high of the dot-com bubble, the NASDAQ dropped down between 77 and 83%, depending, I think, on whether you looked at a close or an intraday drop. 77%. Now think about it. For all of you folks out there that think you're smart, you think you got the magic crystal ball, we got a great bull market. We arguably have a massive bubble market. Can you imagine losing 77% of what you see on your day trading screen every day? Good question to ask, right? Let me jump back into John's newsletter. He goes on to say, "Nothing so animates a speculative herd as a parabolic price advance in an asset detached from any standard of value." John says, "I am convinced that future generations will use the present moment to define the concept of a reckless, speculative extreme, in the same way our generation uses 1929 and 2000. John notes, "One of the hallmarks of every bubble is a loss of interest or ability of investors to distinguish between investments and speculation. Once this mentality has taken hold and prices become wildly elevated, it is impossible to sustain the bubble without also making its consequences worse." In 1934, Benjamin Graham and David Dodd described the spectacular errors of investors that ultimately contributed to the 89% market loss between 1929 and 1932. One error was the willingness to abandon concern for the concept of investment, the purchase of securities at prices that provide a reasonable expectation of adequate return. The companion error to that was a growing enthusiasm for price-insensitive, passive investment approaches. Now, I won't go on to read it, but you should go check out John's newsletter and read the excerpt from Ben Graham and David Dodd, circa 1934. Now, look, I'm not a value guy. I am price insensitive in the sense that if price is going up, I want to be long. If price is going down, I want to be short. That's not the point of delving into John's world right now with you. The point, and you will see this in a few more minutes, as you see all the various ways that John outlines the current situation. That's what I see as beneficial to John. John, to me, is the ultimate sentiment gatherer. He pulls together all of that sentiment from his quant understanding, from his perspective, and all the assorted measures. And as you will see in a moment, those measures say that we are frothy as hell right now. John continues in his newsletter, the current situation would not be as dangerous if the stocks in the highest valuation deciles accounted for a small percentage of S&P 500 market capitalization. Unfortunately, that is not the case. The largest S&P 500 components by market capitalization have eclipsed the price-revenue multiples observed among the largest stocks at the 2000 pre-collapse peak, while the smallest S&P 500 components have eclipsed the price-revenue multiples observed at the 2007 pre-collapse peak. John notes, as my friend Jesse Felder puts it, this is an everything bubble. Now, some people might be thinking, but Mike, but John, what about the good stocks? Now, again, from my perspective, I don't know what the hell a good stock necessarily is. I want to be long if one's going up, and I want to be short if one is going down, or I want to be out of that one if it's going down. John goes on to note some blue chip performance from the 73-74 bear market. Let me rattle some of these off. DuPont minus 58%, Kodak minus 62%, Exxon minus 46%, Ford minus 64%, GE minus 60%, GM minus 71%, Goodyear minus 63%, IBM minus 58%, McDonald's minus 72%, Mobil minus 59%, Pepsi minus 67%, Philip Morris minus 50%, Sony minus 80%. You get the picture? Back to my opening salvo with how far markets can drop. You have to look at your portfolio right now if you don't have a strategy. And you got to say to yourself, am I comfortable with all of this dropping 50 to 75%? If you are, then throw me away. Seriously, throw me away. You don't need to know where we are right now by comparison to prior historic manias. John goes on to relate a little passage from the famed book, A Random Walk Down Wall Street, from Burton Malkiel. To quote Burton, I have a good friend who once built a modest stake into a small fortune. Then along came a stock called Alphanumeric. In addition to providing an exciting name, it also promised to revolutionize the method of feeding data into computers. My friend was hooked. I begged him to investigate first whether the huge future earnings that were already reflected in the price could possibly be achieved given the likely size of the market. Of course, the stock had no current earnings. He thanked me for my advice, but dismissed it by saying that stock prices weren't based on fundamentals like earnings and dividends. They're based on hopes and dreams, he said. And so my friend had to rush in before the crowd could bid up the price, and rush in he did, buying at $80, which was close to the peak of the craze in that particular stock. The stock plunged to $2, and with it, my friend's fortune. End quote. From A Random Walk Down Wall Street. Now that is from a fundamental perspective. That's from a value perspective. I don't have any problem with somebody getting on board some wild bucking bronco when you don't have any idea what the fundamentals are and riding it, as long as you got a stop loss. So you don't go from 80 to 2. How do you go from 80 to 2? Like, that's insanity. You buy at 80 and you hold all the way to 2? Like, that's like therapist shit. Get on the shrink's couch. You got a lot more problems than the stock market. Seriously. So again, the whole point of mixing in my trend following perspective today with John Hussman's perspective, his value perspective, Burton Malkiel's value perspective, Benjamin Graham's value perspective, is they are great sentiment indicators in a way. They show how far we have got from the mean, how far extended the rubber band is. Now, that doesn't mean the rubber band can't expand more and more and more and more. But at some point in time, the SOB breaks, it snaps. And I got to tell you, I said this on Twitter, I said this on Facebook. Right now, I am hearing from some of the people that I never hear from who are now investors. I mean, really crazy tune stuff. And to me, that is surely a sentiment indicator that we're getting, as I said earlier, frothy. Now, for me, what I'm about to read is one of my favorite parts of this newsletter that John Hussman has put together from a sentiment perspective to give us an indication of where we are contrasted to prior periods. John notes, it's important to understand that Fed easing supports the stock market only by affecting investor psychology. The Fed buys interest-bearing securities and replaces them with zero interest-based money. That's it. Instead of holding savings in the form of treasury security, someone holds their savings in the form of a bank balance. The fact that they have a zero interest bank balance instead of a low interest treasury bill doesn't mean they change their consumption or retirement plans. It just means someone in the economy has more psychological discomfort because every dollar of base money created by the Fed has to be held by someone at every moment in time until it's retired. You can try to get out of cash by buying stocks, but only by bidding up stock prices enough for a seller to accept the cash in return. Yes, you now own more stocks, but your cash is now held by that seller. There are no sidelines. Every security is held exactly as before. Nothing has changed except the owners. The problem is that the psychological impulse to own something other than cash, regardless of price, has created a situation where stock market valuations have been bid up to levels that imply negative S&P 500 total returns for well over 12 years. Now let that sink in for a second. John's really talking to the passive mutual fund crowd. You, Mr. and Mrs. Passive Mutual Fund, are in the middle of stocks that have been bid up so high. That doesn't mean John's saying they can't go higher. He's not saying that. They can definitely go higher. But at this moment, they've been bid up so high that at this price right now, if you roll forward 12 years, you would expect to have the same amount of money, the same value. That's how high we are. Now, that is just contrasting to prior periods from the John Hussman value perspective. And as I have said repeatedly on this episode right now, that's a fantastic sentiment indicator. It shows you where we are in the current mania. Now, I'm not saying to not trade the mania. By all means. From a trend following perspective, much of what John is saying has no bearing on your decisions. It really has no bearing, not just little, like none. Ultimately, if you're a true trend following trader, none of this matters. Now, I bring it up because I like to convert people. I like to give people a perspective that they might not know. So when John points out that we are at elevated equities levels, and if you just sit there for the next 12 years, those levels are so elevated that you'll have the same money 12 years from now. Who can think, you out there, the buy and holder, who of you can actually imagine getting no return for 12 years? Zippo. Now, of course, there might be some kicking the can down the road, some extra jerry-rigging from the Fed. And again, if you're a trend-following trader, who cares? You got your stop losses in, not relevant. But I'm talking to a wider audience than trend-following traders alone. I'm talking to everyone. And a guy like John Hussman, again, lets us see, in contrast, in comparison, where we are today against the history of the United States of America. And we are currently at elevated levels never seen before. Now, in this newsletter, John goes into a pretty ominous perspective from his perspective. And he uses the phrase, the trap door is open. The vertical losses. That's how extreme he sees the situation. This parabolic move up where every Tom, Dick, and Harry is trying to make a bloody fortune in 5 minutes because the damn human greed is fully on display. But that trap door is open. And you got to be careful that you are not standing on that door with your net worth when it opens. I've noticed recently, as we talk about parabolic advances, we talk about bubbles, and we talk about manias, I've noticed recently that one of the cheerleaders for Bitcoin and crypto, and I don't have anything against Bitcoin and crypto. I'm wishing I had a lot more of it, okay? But one of the cheerleaders for Bitcoin is a guy named Michael Saylor at MicroStrategy out of Northern Virginia. I believe he's a billionaire on Bitcoin paper now. But if you recall, in early 2000, which you might not recall, but in early 2000, at the height of the dot-com bubble, Michael Saylor went on 60 Minutes. He might have spoken to Leslie Stahl. And at that moment in time, his company was worth an insane amount of money. I think on paper at that moment in time, Michael Saylor, this is early 2000, was worth 10 to 20 billion. That was the peak of the dot-com bubble. The absolute peak was Michael Saylor coming on 60 Minutes, backing up his company MicroStrategy. And from that moment in time, wham, bam, thank you, ma'am, the dot-com bubble imploded. MicroStrategy lost an absolute bloody fortune. MicroStrategy collapsed. The stock collapsed. I think it was down 90% plus. Now, please, I'm not trying to pick on Michael Saylor in the sense that I'm questioning his intelligence or questioning his billionaire status. I'm not. But it strikes me as a little curious that one of the men who really was at the forefront right there and then when the dot-com bubble popped is right now at the forefront of Bitcoin. Interesting parallels. Ironic, potentially. Now, of course, if Michael Saylor is a good trend-following trader, he's laughing all the way to the bank because he's got his stop losses in. But do you have your stop losses in? Are you set? Or are you one of these people that John Hussman is talking about who's just sitting there in a passive vehicle waiting to be slaughtered? It doesn't make a difference if markets are at all-time highs if you got a trend-following strategy, because you got a stop loss. I asked someone the other day who's up big. I said, what's your downside protection? What are you planning to do? When do you get out, or do you get out ever? And he immediately said to me, what are you talking about? Where do I put my money? There's no other options. I wasn't telling him to sell. I was simply saying, do you have a stop loss? Do you have an uncle point? Do you have a point where the pain will be too much? This individual did not. The idea had not even crossed his mind. Because ultimately, in the example that I gave, Burton Malkiel, his friend who went from 80 to 2, my friend could go from 80 to 2. Because you got to think about the psychology that starts to unfold. When you don't know why everything has doubled, and you're sitting there and you think you are rich on paper, and you think you are rich in the mind, much more intelligent, what happens when the market starts to go down? Think about the psychology that unfolds in reverse. Well, let me just hold on. Drops another 10%. Let me hold on. Drops another 20%. It's going to come back. Drops another 40%. It's going to come back. Then when it gets down to 2, they throw in the towel and they sell. And literally at that moment in time, they need a therapist for the rest of their life. This shit's not new. 1600s Holland, weren't they trading tulip bulbs for the price of a house? It's an interesting conundrum for me because I come from a trend following perspective. I want to educate that perspective to so many investors. But when I look at the work of a guy like John Hussman, his value perspective, his way of describing the current situation, the current sentiment, I would be amiss if I did not share that information. Now, I'm not telling you that John has a good investment strategy or a bad investment strategy. If you're interested in John's work, you'll have to check that out. That's not the point of this podcast. The point is to get people to have a feeling of mania is here. Mania is upon us. And I got to tell you, I'm really excited. Because when this mania stuff happens, oh my gosh, there is so much money to be made when this kind of stuff just goes poof. And here's what's fun from a trend following perspective. If the market doesn't go poof, there's still a lot of money to be made on the upside. You get them coming, you get them going. Ultimately, you got to be agnostic. All the fundamentals and all the feelings attached to it from a trading perspective don't matter. You ride that damn winner, you got your losses, and that's the game. Everything else does not help you with the bottom line, which is to make money.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.